Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis, and the learning module on topics in long-term liabilities and equity. The first few sentences of this learning module really kind of sum up what we've been doing here for a while in some of these learning modules. There's a sentence in there that sounds something like this, and you've heard me repeat this many, many times over these recordings. That on the right-hand side of the balance sheet, firms, they typically issue debt and they typically issue equity. What do they do with those proceeds? They invest in long-term assets over on the left-hand side of the balance sheet. That's the first sentence or two of this learning module. But then there's a sentence that says something like, well, there are other ways for firms to have access to those assets. And one of those ways is a lease. And so if you look at these three learning outcome statements, the first one clearly tells us about leases. But then the next 2/3 of this learning module are focused on retirement. So you see defined contribution, defined benefit. And then the last third is focused on compensation that's other than like regular old salary stuff. So it looks a little bit like LOS 2 and 3 are a little bit overlapped, but they're probably not in the difference between the definitions that I just gave you. So let's go ahead and start on this first LOS. And this is about half of the number of slides inside of this slide deck. One of the next sentences in that first paragraph or two says something like, hey, if you go beyond issuing debt and equity, that has its own set of complexities, but we add another layer of complexification when we talk about leases. Now, the good news for you guys is that if you rely on the signal that the Institute gives you using the questions at the end of a learning module, the complexification of the discussion on leases is not very severe. In fact, those questions at the end of the learning module, I think, are super simple. So what we've done is we've given some extra problems, some extra complexity in here so that you can answer almost any question that the Institute might come up with. So let's start off with a couple of definitions here, right? We have the lessee and the lessor. And so what happens? One party says, you know what? I'll pay you $100 a year for 5 years if you let me use this asset. Couple of conditions that we need to follow in case there is a question of whether or not this is an actual lease or not. I guess this is a good exam question, but it would be super simple here. So look at those 3 bullet points down on the left-hand column. Specific underlying asset. There's a section inside of the learning module where there's a paragraph that says something like, oh, there's a little bit of confusion over which assets we're going to lease, which ones we own, which ones we're going to just rent, which ones we're just going to not use. So it has to be a specific underlying asset. So my comparison is just think of this as kind of a secured, as a relationship to a secured bond, where that bond is secured by a specific asset. It's not identical, but it helps you kind of get this idea of what these conditions for lease accounting might be. So then the customer, right, then the person gets the idea about, hey, I'm going to use this asset for this particular purpose. And then there are certain rights that the customer gets. So there are 2 examples over there on the right-hand side. Hopefully you've read those as I've gone over the left-hand bullet points. But those should be obvious. Advantages. This is probably a good question, but there's no way. It seems to me like there's no way you could get this wrong on the exam. You don't have to buy the asset. That makes perfect sense. Lower upfront costs. Remember now, we had lots and lots of good discussions on, the required return on a bond issue and the required return on a common stock issue. So we computed that weighted average cost of capital. But the idea here with a lease is that because it's secured by an asset, that you're probably, I'm not going to say definitely, but you're probably going to get a lower interest rate. So there's cost effectiveness. And then there's the idea of convenience, that you have the use of this asset, but you don't own it in the traditional sense of ownership of the asset. And so you can always send it back. So there's convenience. Now, what the learning module tells you in a couple of sentences about obsolescence. So if you own the asset, then you have to worry about it not being valuable after some time. If you have leased the asset, then you can always just send it back or trade it in for a better asset. From the lessor's perspective, interest income, broader market reach, all those kind of good things. So here's I think there are 2 questions at the end of this learning module on identifying whether it's a finance lease or an operating lease, and a couple of different things that are at work here. But I want you to remember that if the lease resembles like a purchase, think about when, I don't ever do this, but I'm guessing lots of people do. If you go down to the auto dealership and instead of buying the car, you lease the car. Well, if it looks like a purchase, then it's called a finance lease, but then all other leases are operating lease. So that's what we have over there on the right. And in fact, this is taken right out of the learning module. Here's a good exam question. This shows up at the end of the learning module. So it's going to be a finance lease if any of the following 5 criteria. And this is true under U.S. rules and the International Financial Reporting Standards. So just memorize these 5, because it's a great exam question where you'll get some of these and then there'll be something else that's not in these 5, and you'll have to identify what kind of a lease it is. So let's work through just a quick example here. So we have an agreement, company M and N, $200,000, 3 years, exclusive use of a specialized vehicle. So there's the identification of the special or the specific asset. Present value $540. Company M will return the vehicle. Does not include a purchase provision. So this is what you should be thinking. You should have this memorized, and you should be checking off. Was that a 1 or 2 or 3 or 4 or 5? This vehicle can be used by different clients in various industries. So the useful life. So what are we doing here? This is a 3-year lease, but it's going to last for 7 years. Who knows how they came up with that 7-year life? But who cares how they came up with it? The Institute will go ahead and give you 3 years and 7 years, so that's probably important. Fair value $550, so compare the $540 to the $550. So what type of lease is described above? And then question 2 is, suppose the fair value is not the $550. Suppose that it's $1 million. All right, so this first one here, you should have been all over this, right? This is a finance lease, so there's a little bit of math there, 98% if you want to do the calculations. But hopefully you don't need to, on the exam, get out your calculator and do, what's 54 divided by 55? That sounds almost like 1 or 100%. Now, if the fair value goes to $1 million, then what happens is that becomes an operating lease. Now, some good questions on the exam might be something like, all right, we have the 2 parties. We have the lessee and the lessor. Do they report things in identical ways? Does the international group and the US GAAP, do they have different kinds of rules? And of course, you would love for me to say the answer to that is, well, everything's identical. But of course, they're not going to be identical. So how do we report? So look at that first bullet point. Depends on if you're over here on the left or over here on the right. Depends on whether we're international or US. Depends on whether it's a finance or an operating lease. And then there's some interesting things down there at the bottom. You can read that. So if we have these low value assets, I don't think this is a very interesting question. Who cares about something for $100 or $400 or $3,000? I mean, some people do, but I don't think those are really good exam questions. So let's do lessee accounting from the international perspective first. Single accounting model for both finance and operating leases. So that's pretty simple for you guys preparing for the exam. So what happens with the initial recognition? So think about it. If you now we're the lessee, so if we buy the asset, We put the asset on the left-hand side of our balance sheet, and then however we paid for it, maybe we issued a bond, maybe we issued shares of stock, maybe we paid for it with cash, so then we would have to debit cash for those of you who are accountants out there. So we've got to come up with something that sounds an awful lot like that journal entry. So what we're going to do is we're going to call this a right of use asset. We're not going to call it, property, plant, and equipment. We'll have a separate section in there, right of use. And then we'll have some liability on the right-hand side of the balance sheet. Let's just call it lease payable, right? Both of those amounts, right? So regular old accounting stuff, assets and liabilities. So they're going to have equal to the present value of those future lease payments. And then the discount rate is either the implied lease rate or some kind of secured borrowing rate. Notice that on this slide we use the word estimated. In the examples in the learning module, and then at the end of the learning module, you don't have to pick. The Institute gives you either one or the other. So I would be prepared just to use one or the other. But I would also be prepared to answer a non-quantitative question in which it says something like you can use either one. Now what happens over time? So we make that original journal entry, and then we start paying this off, right? So if we owe 100 and we pay 30 and 30 and 30, whatever that is, then something has to happen. This sounds an awful lot like depreciation of a physical asset. It sounds an awful lot like amortization of a non-tangible asset. So we've got to do those kinds of things here. So this lease liability, what we're going to do is use this thing called the effective interest method. So each payment is going to have two components, and this sounds an awful lot like the amort button on your financial calculator, because it probably is. So if you flip over to the asset, of course, we're going to amortize it. We could use straight line basis, and that's probably what the Institute will ask you to do. However, the liability and the asset amount are probably not going to be identical as we go through time, and we'll show you that example here in just a second. This is always a good exam question. What does this look like on financial statements? So there are some interesting things on the balance sheet, the income statement, and the cash flow statement. I would remember over on the cash flow statement that we've got the principal payment and the interest expense. And so those two things are probably going to be separate. On the income statement, you'll have an interest expense and you'll have an amortization expense. Notice in parentheses, we have reported separately there. They're not going to show up on the same line. And then on the balance sheet, remember we've got an asset and we have a liability. So these two things are going to decline over time, right? Now they may not decline at the same rate, which is what I just said in that previous slide. All right, so let's take a look at an example here. We have a 4-year lease, interest rate of 8%, lease payments of $90,000. There'll be straight line amortization. So discuss the effect on all of those different kinds of statements. All right, so the first thing that we need to do is figure out what we're going to put down on that original journal entry. I'm guessing you guys are experts on your financial calculator, but if not, go ahead and pause the video and put an N of 5, I of 8, payment 90,000. Remember, I say this before, don't forget to hit future value of 0, because your calculator will remember that previous future value, unless, now if you guys are using the BA2 Plus, unless you do one of those, second clear all, then that'll wipe it out. Then you don't have to put the 0 in there, but my heavens, please get in the habit of putting the 0 in for time value of money questions, whether or not you clear it. I teach my students that all the time. So you get, what is that number? Almost $300,000. So 298,091. So that shows up on the left-hand side. That shows up on the right-hand side of the balance sheet. Now, I would be prepared to go ahead and work through this particular table, although there are no such questions at the end of the learning module, but there's this stuff inside of the learning module. All right, so let's go ahead and identify the interest expense and the amortization expense, and then how much are we going to report this asset down on the bottom right. All right, so let's go ahead and start up at the top right-hand column under that lease liability. So notice that's year zero. There's the $298,091 that we computed as the present value. So in the purple column, we've got our payments of $90,000 every year, and there's the total of $360,000. So the question then becomes, how do we get each of those numbers? So we're paying $90,000. So this is just like that amort function on your calculator. Some of it is going to be interest and some of it is going to be principal. So what we're going to do is, you guys have your calculators out. You want to do this, or are you just going to trust me on this? So put the $298,091. You have that from the previous calculation, right? Multiply that by the 0.08 and you'll get the 23,847. Hit your plus minus button on your calculator, then add the 90,000 and you'll get the 66,153. So 23 and 66, that has to sum to 90. That should make perfect sense. And then let's go ahead and in the orange column, we've got the 66,153. That was the principal payment, the principal repayment. So we need to take that from the 298,091. So our lease liability is 231. So you can do this all the way down. And you can see that the interest expenses total 61. The principal repayment totals the 298. Of course, the present value was 298, so we have to repay 298, and then the 61 is the interest. So if you sum those two, you get the 360. So this is what happens on the right-hand side of the balance sheet. There's that lease liability, and then the interest expense that shows up on the income statement. But then what happens over on the left-hand side? Remember back here, let me just remind you, what does it say somewhere here? Where is it? Oh no, it was back here. Yeah, straight line, we're going to amortize straight line. So take the 298,091, divide that by 4, and you get 74,523. So that's the same. So notice we're paying 90 every year, but our amortization expense is 74 every year. That gets us up to the 298. So then just subtract the 74 from the 298 and you'll get the 223, the 149, the 74. And then of course at the end of that time period, it has to be 0. So this table here goes back and addresses the question of what happens on the balance sheet, what happens on the income statement. And so look, what does the LOS say? Explain financial reporting of leases from the perspective. So this is a good table to be able to construct and to reconstruct for the exam. All right, so we did balance sheet and income statement here. So on the statement of cash flows, so that principal payment, that's the cash flow under the financing activities, and the interest expense is under either the financing activities or the operating activities. Remember, there are lots of times in the international arena where they don't really care. You can do operating or financing. And so the example down there's some of the numbers that we did. Now let's switch back to the U.S. rules. So notice under the finance lease, they're the same, but the operating leases, we're going to have some differentiation. And so the differentiation, and by the way, we have a good example that's going to show that difference here just in a second. And so at inception, what we're going to do is we're going to have the lease payable liability, and we're going to have the right of use asset recorded on the balance sheet. And then we're going to reduce that by the principal repayment and the amortization. And that sounds an awful lot like what we did, but there's going to be a difference in the calculation of that amortization on the right of use asset. So look over in the blue. We've got to worry about now the lease payment minus the interest expense. And so there are some implications for equations. So look on that, what is that, the first block point there. Make sure you take the interest and add the amortization. The lease liability, look at the bottom, lease liability will always be equal Yeah, that's going to make perfect sense here in just a second. So what about the three statements? All right, so on the balance sheet, that lease liability is net of those principal repayments. Over on the income statement, there's the interest and the amortization on that single line. So remember, I told you earlier there are different lines. And then interest and amortization is separately, and it can be grouped with other types of expenses. On the cash flow statement, those are operating activities for that lease payment, and interest and principal are not separated. You know, from my perspective as a good old finance PhD, I really don't care how many lines that show up. Just tell me what's on there. Let me know what's on there. But apparently, all of you accounting people, you have to keep track of what's on each line. And I commend you for having the discipline and the skill to be able to do all that kind of stuff. Let's go back and work on the same example, but this time under the U.S. rules. So look in the middle, in the purple, there's the asset value, the 298,091. Down the left-hand column, there are the 4 years. The amortization expense is going to be, well, let's do this 66,153. So let's take 8% of the 298 and then subtract it from the 90,000, and you ought to get that 66,153. And then if you continue to do that, going down the bottom, the value of the asset goes to zero, and then the lease expenses, of course, they sum to 360, and the amortization expenses, they sum to 298. All right, so that those principal repayments, those show up, those values show up on the balance sheet. Then those lease expenses, that's on the income statement, and then that 90,000 shows up on the cash flow statement. Let's move over to the Lessor Accounting. Mostly identical, so that's pretty much good news for you guys. Classified as either finance or operating lease. So let's take a look at what happens at the beginning and what happens during the middle. So at the lease inception, what happens is that, well, let's think about it. So if we're the lessor, we own this asset. We're going to recognize a lease receivable. We're going to recognize another asset. So you can't have, on the left-hand side of the balance sheet, you can't have a line for each asset. So you have to get rid of one. So we're going to recognize a lease receivable as the present value of those lease payments. And then we have to de-recognize the leased asset, which means we have to get rid of it. De-recognition, I don't even know if that's a word. So you have to put in some kind of journal entry that says we're getting rid of that leased asset, and then you'll have to recognize any gain or loss, and we'll use some kind of implicit discount rate for these calculations. So what happens over time then? That lease receivable is going to be reduced using this effective interest method. So there's a good formula down there. I would probably know how to do that. Interest income and principal. Make sure you can do that. And that math is based on those tables that we just did. What happens on the on the financial statement? So if it's a finance lease, what we need to do is worry about the balance sheet. So that lease receivable, that's net of the principal proceeds. So the income statement, we're going to have to report that interest income. And then cash flow statement, that's going to be under the operating activities. If it's an operating lease, this contract looks like it does if there's a rental agreement. Make sure that you remember that this lease revenue is going to be recognized on a straight line basis. What about an operating lease? So the balance sheet, not impacted, income statement, lease revenue, straight line basis, I just said that. That's similar to what, let me go back here real quick. Sorry, yeah, that's what I just said right there on that operating lease. And that's on the income statement. And then the cash flow statement, that's operating activities. Let's move on to the second LOS, defined contribution and benefit plans and some stock-based compensation plans. I want you to think about this compensation in the following manner. I'm the employee, you guys are the firm. So if you pay me a salary, you pay me cash, right? So what do? You have to credit cash, and then you debit, call it wage expense or employee compensation expense or something like that. So that's pretty straightforward. And that includes, look at the components there, salaries and bonuses. And then the Institute talks a little bit about non-monetary benefits. I can't imagine that it would ask you a question on how do you handle it if an executive uses a limousine service. Well, this is all part of operations, so just do the same thing. Just credit cash and debit. I don't know, call it limousine compensation service or something like compensation expense or something like that. But the point is then that let's worry about what happens when it's not as obvious as it was back in Accounting 101 when we had that in college 100 years ago. What if there's some kind of a retirement issue, some kind of a deferred issue, or as in this third part, stock-based compensation plan, suppose the compensation is in the form of a share of stock, or something that looks like a share of stock. So those are the more interesting questions. This first page here, this is not interesting. But go ahead and look at the top. This might be a question, I don't know, meets liquidity needs, retain talent, motivate performance. We'll talk a little bit about that as we go through the slide deck. Compensation expenses, fair value. I mean, if you pay me $100 in cash as part of my salary, you have to report it as $100, right? So that's the fair value. So you have to worry about cash outflows or liabilities. And then you remember we'd had this conversation on the matching of assets and liabilities. Well, it's kind of the same thing here. The expenses and cash outflows should be, how about identically matched? The Institute uses the term well matched. Do you remember at the beginning of this slide deck, I said that the first sentence or two was something about complexification? Well, this is the second time that the Institute uses this term complexity. But the good news for you guys is that when you go to those 15 problems at the end of this learning module, you're going to say, boy, these are not complex at all. And in fact, they're mostly definitional. There's hardly any kind of application. There might be one or two super easy math questions. Now, I say that because I'm warning you that in level 2, we're going to have to do lots and lots of substantial math to compute things like the defined benefit obligation and some other things inside of this topic area. So my point is even though the Institute says complexity, I'm telling you to enjoy the simplicity of this learning module. Now, why is it complex? And this is probably a good answer for lots of complexifications, is that there's a time lag. Remember at some point we talked about, or we will talk about, deferred tax liabilities and deferred tax assets. And those probably arise mostly because there's different time periods. So remember a time lag in here. And also there's some management judgment issues. I'm guessing you don't need me to help you define the defined contribution plan or the defined benefit plan or some other post-employment benefit plans. Let's go ahead and talk about those specifically as they relate to this learning module. As a college professor, I have a defined contribution plan. I put in 5% of my salary, and my school puts in whatever percent they put in. I get to dictate where that goes. I could say I want it to go to the casino fund, and the casino fund manager could take my contributions and my employer's contributions and go to Las Vegas and bet it on the black 1 month, bet it on the red another month. By the time I retire, I could have $1 trillion if I had a good, lucky win streak. On the other hand, and the most likely outcome is I probably have $0 when I retire. But the point is that I get to dictate, which means that the employee bears all of the investment risk. And that's probably, one of the better questions in this section. Let's see. Remember, it's just a regular old operating expense, shows up under operating activities in the cash flow statement. So look at the middle bullet point there. The employee, bears the investment risk. That's the important one. No disclosures here, because once that money goes from my school over to the casino fund or to Jim's retirement fund, the school doesn't really care what happens to it, at least from a philosophical standpoint and a financial standpoint. The more interesting of the two, of course, is the defined benefit pension plan. So what happens is that the employer will say something like, okay, Jim, if you worked for us for 30 years, your average salary over your last 3 years is $200,000 a year. So we'll pay you, right, defined benefit, we'll pay you 90% of that, or 70% of that, or 30% of that, or 5% of that, whatever it is. And you've got to make some assumptions, because I'm 63 right now. I might not retire for another 20 years, have all these expenses, right? So the employer has to say, all right, Jim thinks he's going to retire in 20 years. Therefore, we're going to invest some money today, and hopefully when he retires in 20 years, we'll have enough future salary, life expectancy, discount rates. Now, the most interesting question here is going to be, hey, here's a pension fund, and it has either a surplus or a deficit. My advice is that if you get a question in which there's a surplus, you should write the Institute a little note. There are no such things as surpluses in defined benefit pension plans. If you read the Wall Street Journal regularly, like I tell you to, you'll know that to be true. Nevertheless, the Institute could give you a plan that has a surplus or a deficit. Just remember, it's the difference between the assets and the liabilities. What we're going to do in order to measure that is we're going to take the present value. So there's that second embedded bullet point, present value of those future benefits using some kind of a relevant discount rate. The Institute tells us high quality corporate bond yield is one acceptable rate, but it doesn't have to be that one. It could be something else that is reasonable. Now, I'm not a big fan of the difference, you've heard me say this before, the difference between the international and the U.S. standards, but the Institute really likes to test these things. And let me show you this. So there's 2 slides on the International Financial Reporting Standards and 2 slides on the Generally Accepted Accounting Principles. So this is probably what the Institute is going to say. This is what kind of a question that I would create. I would say something like, here's a company, operates in a country that uses the international standards. And then the question is, which of the following is an employee service cost? How do we handle these things? Oh, look at the third one there, recognized in the profit or loss in that period incurred. So that shows up on the income statement. What about net interest income? What about interest expense? Notice you've got to do present values in there, the change in present value. You might have to calculate a present value. That's probably not a bad question. Once again, profit and loss. How about remeasurements? And these remeasurements can be anything from something simple as, suppose that some country says, you know what, we told you could retire when you're 64, but we've now changed that to 68 in order to get some kind of government pension. Well, there you go. So that's going to change those retirement ages. Then you have to worry about how much extra compensation that those employees make over that extra 4 years, employee turnover, mortality rates. I say this regularly to my students. They don't really get it. I'll say something like, hey, I'll see you guys on Monday, unless I croak over the weekend. Anything can happen. So you need to worry about mortality rates. That's why lots and lots of these firms, have actuaries so that they can, as soon as something changes, the actuaries can get out their slide rule and figure out what the impact of those changes are going to be. And then actual return on plan assets, that's probably important. Notice that there's no amortization over time. So think about these international rules, and then the Institute could give you a question right afterwards and say, here's a firm, operates in the United States, and it has similar stuff. So what do we do about the service costs, the interest expense? And you can see some of the differences here. But with the US GAAP, you got to also worry about past service costs and actuarial gains and losses. So they show up in that thing called other comprehensive income. So if you remember, we did this in a previous learning module, that other comprehensive income is really just other stuff that occurs that doesn't look like regular stuff that we do. Word of advice here, the Institute does not spend much time on defined contribution and just a little bit more time on the defined benefits, but way more time on these stock-based compensations plans. So why are we doing this? Well, look at the second checkpoint there. Incentivizes long-term company performance. So what do we know? We've talked about this multiple times. Goal of the business, maximize shareholder wealth. How do executives do this? Well, kind of the general umbrella answer is that they select projects that have positive net present values, which ultimately means that stock price will rise. So what this does is it links the personal goal of the executive with the maximized shareholder wealth goal of the firm. So think about this. Once again, I'm the employee, I'm the CFO, you guys are the board of directors and the decision makers out there. So what could you do? You can pay me a salary. You can pay me $100 today and I go cash the check and everybody's happy. But you could also say, you know what, Jim, we're going to give you $95 plus we're going to give you something else, a piece of paper that gives you either value today or value tomorrow. So that's the stock-based compensation plan. That piece of paper is tied to the value of the company. So it aligns the managerial interest with shareholder goals. Disadvantages, if this is a share of stock and it's an actual share of stock, well then there's dilution. That means there's more shareholders out there, more outstanding shares. So look down at the bottom right, that last checkpoint, it's going to have some impact on earnings per share. There's going to be more outstanding shares, so there's going to be a greater denominator. And when you hand me that share of stock, you have to expense it. So that's going to that's going to increase expenses, lower the net income. So that when that shows up, at the bottom of the income statement, that's going to have a lower earnings per share. And then this middle checkpoint, I'm going to go ahead and scratch my head. And I don't want to give you too much of my personal thought here, but this is what the Institute is wanting you to get at. That if you hand me a share of stock that's valued at $100, well, I might be a super conservative person. And I might say, you know what? I don't want to lose any money on that share of stock. So therefore, I am not going to take any risk in these capital budgeting projects. I'm going to just invest in regular old brand name product lines so that I can preserve the value of that share of stock. So that's the first part of this. Risk aversion means that the executives, this share of stock may influence me in my capital budgeting decisions or my capital structure decisions. On the other hand, if you give me the share of stock that's worth $100, I might say, hey, I'm going to invest in super risky assets out there so that I can turn that into $200 or $300. So be prepared for a question in which you have an executive that exhibits risk aversion and an executive that exhibits risk-seeking behavior. And so that's what is meant by misaligned incentives. But this depends on the willingness and the attitude of those individual executives towards risk. I talked way too much about that. I can't imagine that the Institute is going to ask a question on there, but I think it's a good question. But there's so many other good questions that the Institute could ask. All right, what did I say earlier? If you hand me a share of stock that is currently trading on the New York Stock Exchange for $100, well, you need to report that on the financial statements as being worth $100. So as you know from previous learning modules, the Institute refers to this as the fair value, and it has to be on the grant date. And that's going to show up on the income statement as an expense. And we'll talk a little bit about that as we go through the next couple of slides. Note that if that stock price is $100 today, the firm expenses that as $100. If the stock price goes up to $200 or $800 or $5,000, the firm doesn't have to keep adjusting that thing. The only thing that matters is what happens on the grant date for this stock compensation plan. Now, it can take the form of stock grants, which we'll do here, and then stock options, which we'll do here in just a little bit. So think about the types of stock grants. An outright stock grant is exactly what I was saying earlier. You hand me a share of stock, and I can do whatever I want with it. I can go sell it. I can put it in my back pocket. I can take it home and put it on my bulletin board. I can do whatever I want with it. It is now mine, an outright stock grant. What happens then is that expense is allocated over some kind of a period. And you probably wouldn't have to pick what that service period is. Maybe it's 3 years, maybe it's 5 years. I don't know what it is. But the institute will probably have to give you something like that if they want you to answer some type of a math question, although I think that's pretty unlikely. Now, this outright stock grant also is a general way to do this. So what we need to do is be more specific, because if you hand me that share of stock, you don't really want me to sell it right away. I can, but sometimes I can't. So let's talk about sometimes when I can't. Well, one of those is called a restricted stock grant. And you guys might say to me that, you know what, Jim, we're gonna hand you this share of stock, but we'll tug back and forth like Chevy Chase does in one of his funny movies. We'll tug back and forth, but they'll say, you know what? You can't sell this share of stock. You can't take full ownership of this share of stock unless some stuff is met. Maybe we'll let you have it if you've been here for 5 months. Or maybe if the return on equity increases by 2% in the next 1 year. Or you could have all sorts of restrictions associated with the stock grant. But notice the two that we have in parentheses there: remain employed, meet performance goals. That should make perfect sense. Now, a type of one of these restricted stock grants is a performance share, because this is tied to specific measures of performance. Like, what did I say earlier? Return on equity. Here we have return on assets. Could be accounting earnings, could be changes in cash flow. I mean, it could be almost anything. And what this does then is it removes, and this is the good exam question here, it removes the volatility in stock price, right? If you have this share of stock that goes up and down and up and down, then your stock grant goes up and down and up and down. But if we say, you know what, Jim, here's a share of stock, but we'll let you have it after you've met these kinds of performance measurements, if you meet some of these other kinds of conditions, and those conditions can be almost anything that the firm decides. Here's a good question. Look at that third bullet point: incentives to manipulate accounting figures like accounting earnings or return on assets. But the compensation is based, once again, on the fair value at the grant date. All right, so those are, if you hand me a share of stock. Sometimes you hand me the share of stock. Sometimes, there's some restrictions in it. But what about a stock option? A stock option, you should remember this. The definition of an option is the right, but not the obligation, to buy a share of stock. Oh boy, so this is completely different than being handed an actual physical share of stock. So what happens is that you will hand me a piece of paper that gives me the right to buy a share of stock at a fixed price. Let's suppose that price is $100. The current market price of the stock might be $75. So my option doesn't have any value. I'm not going to exercise my option. Why would I want to buy something for $100 when I could go to the New York Stock Exchange and buy it for $75? But the idea here is that I'm going to do my best. I'm going to make great capital budgeting and great capital structure decisions so that the stock price goes up to $125. Now my piece of paper becomes super valuable. I can exercise my option and pay the firm $100, and then I could immediately go and sell it for $125. These are the terms in the money and out of the money. So the question then becomes, and by the way, we'll talk about options extensively in level 2 and level 3. But what the Institute is probably going to be interested in asking here in this learning module is how do we determine what that expense that shows up on the income statement is going to be. We know it has to be fair value. We had already talked about that. But how do you value an option? Well, you use a well-known option pricing model. Level 2, we're going to actually calculate the price of an option using the Black-Scholes-Merton option pricing model and calculate the price using the binomial option pricing model. And you're going to love those recordings because everyone's going to tell you, oh, don't worry about calculating the price of an option using the BSM model. It's way too complex. It's just too difficult. Just skip that question. But I'm here to tell you that it's an easy giveaway question if you pay attention to some things that I'll teach you. You don't need to worry about any of that right now. What you do need to worry about is that there are a bunch of inputs to compute this fair value of the price. So you're going to have to know these. You're going to have to memorize these in level 2. So you might as well get started now. What does the price of an option depend on? It depends on an interest rate. It's going to be the risk-free rate. Don't worry about that right now. We'll talk about that later. If there's a dividend, it's going to depend on dividend. It's going to depend on the exercise price. It's going to depend on the stock, the underlying stock price. It's going to depend on the life of the option, and it's going to depend on the standard deviation of the underlying asset. In this case, it's the underlying stock. So a good question would be in multiple choice form. Here's an analyst trying to value these options granted to an executive. Which of the following is most likely going to be an input or most likely not going to be an input, depending on how the institute words those. So my advice is to start memorizing those bullet points there. Now, another good question is, hey, how do we determine which model do we like? I mean, back here, we could use Black-Scholes-Merton model, or we could use Jim's crazy model. Well, Jim's crazy model is not going to be consistent with fair value, has no establishment in economic or financial theory, and Jim's crazy model doesn't reflect some of the characteristics of that option award. So remember, so back here, let me go back here quickly. We're going to do fair value. There it is. And this is what it means to have a fair value. Those of you who have accounting backgrounds will know this by definition and by heart. Key dates, the grant date, this is when the board grants these. The vesting date is the date when the employee can first exercise the option. So you may hand me this piece of paper that gives me the right but not the obligation to buy a share of stock at a fixed price. But it might say, you know what, Jim, you have to work for us for 3 years or 4 years before you can do that. That's the vesting period. Now, sometimes the vesting date is going to be equal to the exercise date. So as soon as I become vested, I may exercise the option, but I might not. If I have a liquidity event, if I'm the executive and I want to build a swimming pool in my backyard, I might go ahead and say, yeah, I'm exercising my options. But I may wait a month or 2 or 3 or 5 years because remember, the option gives me the right but not the obligation to buy a share of stock at a fixed price. Fixed price. And then I'm guessing that you guys, as regular readers of the Wall Street Journal, know that the options that are traded on exchanges and in the over-the-counter market, they typically have expiration dates of less than a year. But with employee options, these things go for longer time periods. You know, the standard is 5 or 10 years. I mean, there's no reason not to go 15 or 20 years or 30 years or 80 years or 100 years. But then you get into complications of retirement and dying, right? So 5 to 10 years is probably a good time period. Some more definitions here: immediate vesting, delayed vesting, conditional vesting, grant date and vesting date. That's called the service period. How do we measure those compensation expenses? And it's based on all those factors that we had in that earlier slide deck. Here's a good summary page. I always tell students, you know this by now, take a picture. This is a good time to take a picture of this. This first one here, what did I say earlier? If you pay me cash as a part of my salary, you're going to credit cash and you're going to debit, Jim's employee compensation expense. However, if it's a share of stock, if it's a share of stock, you got to throw in this additional paid-in capital because it has implications for dilution and equity ownership and all that kind of stuff. I remember an accounting professor once, and by the way, remember, I have an accounting degree as an undergraduate, is that additional paid-in capital, and there are other accounts that accountants kind of just like make up names that sound reasonable. Let's see, when I exercise my option, what I do is that I have to pay you cash, so cash increases, and the number of outstanding shares increases. So that equity increases by the fair value. That's important. Effect on financial statements. So the expenses, so you got revenues minus expenses. So they reduce net income, which then flows over to the retained earnings. So that reduces the retained earnings. We've got to worry about that additional or the paid-in capital, but there's probably no net impact on equity. A couple of other just quick definitional types of share-based compensations. Stock appreciation rights and phantom stock. So the stock appreciation right, it's not a share of stock. It doesn't represent ownership. So that's the advantage. Look at the third diamond point down there. No ownership of shares. So what we're doing is we're kind of like faking each other out. So what you're going to do as the employer, me as the executive, what you're going to do is you're just going to give me a right. There's a piece of paper that says Jim has the right to be compensated based on an increase in the stock price. Now, when the increase in the stock price occurs, all I have to do is say something like, hey, have you seen the stock price go up? Can I have my cash? So you will pay me cash. And it's just kind of like a regular old compensation. But of course, it's based on the bottom right-hand side of the balance sheet. But we don't really treat it like that. We treat it like as kind of a combination of those two. Now, that time period could be a month, could be a year, could be 5 years. It's probably going to be in the low number of years. We're not going to have stock appreciation rights for 1,000 years, but we want to have some kind of a time period where, well, look at the very bottom one, motivate employees and align their interest with shareholders. Now, what did I say here? That when we use these stock appreciation rights, we're kind of faking each other out. Well, when we do the phantom stock, we are really faking each other out. So the stock appreciation rights, these are for companies that trade on the floor of the New York Stock Exchange. So they can go ahead and observe the share price. But what about privately held companies when there is no stock price? So phantom stock, let me go back here. Phantom stock is a stock appreciation right for a company that doesn't trade on the floor of the New York Stock Exchange. So you get by the word phantom, this is made up. So back here, stock appreciation rights, they're kind of faking each other out. Phantom stock, this is entirely made up. Hypothetical stock performance. So what happens is that if I'm your executive and you're a family-owned business, right? We don't have shares trading on the floor of the New York Stock Exchange. You hand me a piece of paper, and there doesn't have to be anything on that piece of paper, but somewhere on that piece of paper is going to be something that sounds an awful lot like these stock appreciation rights, okay? And so what happens over time is I'll say, you know what? I've been doing a really, really hard job. I've been making great decisions. What do you think the value of the company is? So what will happen is that we'll have to go in and try to figure this out. Maybe we'll hire one of you guys once you earn the CFA designation. We'll hire you to come in and value the company and say, you know what, Jim, you've done a great job. Your phantom stock has increased by 200%. And then I could take this piece of paper and turn it back in, and you have to pay me that 200%. So look, private companies can be applied to illiquid companies that don't really trade much, in those third markets or fourth markets. Are we up to a fifth market, or in the dark pools, whatever exists in those dark pools? All right, let's quickly go through this last LOS on disclosure. Here's my advice. You've heard me say this before. When in doubt, go ahead and disclose it. So we need to go through disclosures on the leases that we did in the beginning, and then retirement, and then the stock-based compensation. So let's go through this kind of quickly, and I'll provide you with some caveat that I think I said this quickly earlier. If you look at those 15 questions at the end of the learning module, there are no disclosure questions. So my advice is to, hey, just disclose everything that is material and that you think that shareholders would want to know. Things like back with the lease, the carrying amount, interest expense, depreciation, maturity, lease activities, lease imposed restrictions, sale and lease back, all that kind of stuff that we talked about. So here are, what is this, about 10 or 11 or 12 kinds of issues that probably should be disclosed. Taking in the difference between the finance leases and the operating leases, just remember what those differences are, and then that'll help you with what you should disclose. How about the defined benefit plan? Plan characteristics, how the plan impacts future cash flows, whether there's a deficit or a surplus, sensitivity analysis, composition of plan assets. Of course, you need to tell everybody where you're investing, nature of the benefits, that makes sense. Defined benefits, plan effect on future cash flows. How about share-based compensation? Well, all the stuff that I talked about in the last 15 minutes, throw into the disclosure. Terms, investing, exercise prices, number of shares, measurement details, and that takes us through these learning outcome statements. So what I want you to do is go, and I'm going to tell you this, I bet you don't need more than 5 minutes to answer those 15 questions at the end of this learning module. So if you do that, that'll kind of be a summary, and it'll close the loop on this. It's a pretty long learning module. As one of my father's best friends says to me all the time, I'll see you when I see you. So thanks for watching. I'll see you next time, and good luck studying.